you for joining us on this evening's webinar discussion. Just to kick it off, I'm going to give you about 1 minute exactly to just have a look at our disclaimer, which should be currently showing on your screens. If you can just possibly pop in the chat box that you are currently seeing the disclaimer on the screens. We are trying our best to improve our compliance and legal side as far as possible. And from that perspective, we're just going to leave you for a minute on the webinar quickly to have a read through the disclaimer. Thank you. Perfect. JP, if you can just move on to the next. I see there Rian and Jason has indicated that they can see the disclaimer and that it has been up. So if we can just move over to the next slide, that'll be great.
Right, are you seeing it, Eric?
Perfect. So tonight, one of the things we're going to be talking about, obviously, is the multifamily, and it's currently one of the global real estate trends taking place. We want to really just discuss around the sector as a whole, and just let you know why we think that multifamily is a really good opportunity. And if nothing else, you can leave with a better understanding of the sector as a whole and exactly what's going on in this space. So the first question that we've got up there is, why have institutional investors always considered multifamily investments in their portfolios? The agenda for tonight, we're going to keep it short and sweet. We're trying to get more specific and punchy on these webinars. So from myself, just in terms of introducing the panelists that are on with me tonight and joining on the webinar, we're going to look at that. We're going to look at 7 key considerations for 2017 in the multifamily sector specifically. We're going to look at a current opportunity that we've got available, and then we're going to address some questions and answers. So if we can head over to the next slide, and just with regards to introducing the other 2 panelists here tonight, as well as myself first, my name is Ricky Jack. And I've been with Wealth Migrate for about 3 years now. We're really just a company that's been thriving from strength to strength over the 3 years while I've been here. And in terms of a business overview, we're a multi-awarded winning platform and a KPMG Global Top 50 company offering people alternative ways to invest by partnering with the best-in-class global developers and real estate investment companies. We bring transparency, independent insight, and accessibility to the global real estate investment marketplace through a listed environment. And we make use of our global investment due diligence systems to ensure global consistency in safety, wealth preservation, and sustainability. Over the last 3 years, as you can see, I've mentioned that I've been here for 3 years. So it's been a good journey from the beginning. We've concluded over 6 commercial real estate investment projects with a value of around $100 million. And projects have varied from growth investments over an 18 to 24-month targeted period, or income investments, which are typically between 4 and 5 years. And they've been delivering investors returns from 12 to 19.5% or above. Just to clarify on the return metric there, that would be an internal rate of return. Quarterly dividends, okay, which gets paid out, the cash flow of the building, known as quarterly dividends, is typically between 7 to 9%. And it's paid out, or that's an per annum rate, whereas it's paid out every 3 months. And those are typically paid out only in the income investments because those are buying existing buildings which have a current rent roll from day one. So you can also see there on the income investments, we also still experience an average capital gain of just over 6%. Our clients, you can see we've got a diverse range of clients. In 2016, 15% of our 1,488 users which have registered on the platform in 76 countries made an average investment transaction of $76,000. The minimum investment currently to date has been about $1,000, and currently we've got a really good reinvestment ratio of up to 70% with our investors. So in terms of, just before we get onto yourself, I said that I was going to introduce our panelists. With us tonight, we've got JP DeBrain, and he's one of our top investment consultants at migrate. He's got a strong background in a commercial real estate area in terms of his studies and what he's learned. And we've got Willie Ulfse, who's the head of our due diligence, and who heads up all the diligence on all of these projects. Is extremely competent when it comes to spreadsheets and doing research and analytics and asking all the difficult questions. And typically, he's the guy that's trying to kill the deal before we move ahead with it, and we really, really appreciate that attitude about him. So in terms of telling us more about yourself, please go ahead, use the comment section and let us know what country are you from, and do you currently have any offshore real estate investments? JP, if you can move across to the next slide. Like I said, guys, if you can just fill that in, what country are you from, and do you currently have any offshore investments? 7 key considerations to know for multifamily investing, and this is where our panelists are going to join us a little bit more, and I'm going to actually hand over to some of them in terms of where we're going in the multifamily sector and what we're here to learn about this evening. We're going to be discussing some huge advantages about the sector in terms of creating capital appreciation, consistent demand, impact of millennials on the apartment market, as well as the lower cost of capital and efficient cash distribution, enhancing annual cash on cash returns, and the turnkey partnerships. All of these things are vital to really just pulling together a great investment in the commercial space. So JP, I'm going to hand over to yourself and Willie over here to handle the creating capital appreciation.
All right, great stuff. Good evening, guys. We are looking forward to sharing you the information about this multifamily sector. So with the first point, creating capital appreciation, I think that's one of the things that's so attractive about this sector, is the fact that you have the ability basically to benefit from a couple of things. Being an owner, and what it means is that you can physically, when you look at this this type of transaction, it's usually a couple of units. What we like about this market is the fact that we look at properties that's dated about 1980, which means that effectively it does need some love and tenderness, which effectively allows us to physically do some improvements. In saying that, that means that when you do the improvements on the interior side or on the outside, maybe because it's like a small community, this multifamily, if you think about more like an estate, so in an estate, you've got some amenities that you share, like a swimming pool, maybe some braai facilities or barbecue facilities, and maybe adding some stuff for the kids, and in saying that, it means that you are having the ability to add value to the user experience, which means that you can actually ask a bit more. So what we find is that in these older properties, you have the ability to increase the rate more quicker than what the inflation will be, because of the fact that some of these older buildings, you'll find that the rent didn't keep up as to what the market demands. So it means that the rent goes up, which effectively means your rent roll goes up, which means effectively at the end of the day, on the multifamily is not related to what you find with a house where you're in a typical suburb. That suburb, you can only get 1 million for your house, where in the other suburb it's 2 million, and it's sort of suburb related. On a multifamily, it's a commercial real estate, which means it's affected by your rent roll and the fact that you are able to work on a capitalization rate. So what we'll find is that actually makes sure that at the end of the day, when your rent roll is increased, it means your value has increased as well, just by doing maybe greater operating efficiencies, by maybe cut some of the costs and reducing the vacancies. What we're saying, reducing the vacancies, you're a bit more when you upgrade this property and make it more attractive, you just find that you're able to reduce the vacancies because of the demand, if you keep up to what the millennials love, it'll mean effectively that you will directly have an impact on what the value of the property is. It also means that what is quite attractive in this real estate sector is the fact that in the recession, you find that most guys that usually stayed in a bigger house, they cannot afford maybe the payment or has been an owner, which means that they now have the ability to move to an community which they can rent and have all the amenities in place. So it's actually a good scenario where even in a tough market, your capital will appreciate just because of the fact that you probably won't have that big of a vacancy because you'll actually have an increased demand, which effectively again increases your rate potential. So if you manage the property well and it's fully leased, it'll give you also then a stable cash flow. It's not going to see this rapid day-to-day changes that you would find when you're renting out a house because you only have one tenant. So you've got 250 guys sharing in the bed. If you can move on to some of the other slides.
Yeah, perfect, Willie. I totally agree with what you said. I think I just wanted to add something from my side, which I think is really exciting, and I think you did mention this, is everything is managed under one roof effectively, and I think it's a great efficiency being able to have somebody manage a multifamily property under one roof. And also, I think what's very attractive for me is the shorter term of the leases, which means for me it's really a lot more reactive to what the markets are doing. And you also said the managers of the property can more quickly adjust the rental rates at the moment if they can see there's a bit of a bubble, a bit of a dry spell going in the market. So the adjustability and the reactability in the market with the short-term leases is what I think is also very attractive regarding this. Back to you, Willie.
Sure. Yeah, we can move on.
Sure. Also, I think another thing to take consideration is one of the ratings agency, one of the big three rating agency, actually expects the net operating income in the sector to continue to grow from 2014 up until 2017. You can see that there's been a 73% increase in multifamily properties regarding the borrowers of the commercial mortgage-backed securities. So I think just having that security of the ratings agency having full confidence in the market is also a big fundamental attraction for us as a wealth migrator, and also offering these opportunities to our investors. Moving over swiftly, we're going to have a quick chat on the consistent demand at the moment, which we feel is a fundamental value why we're investing in certain opportunities. Henny Besaidnout, our chairman, also believes you always invest where there's a strong population growth, where there's consistent demand for your property. And we're going to touch on that in just a quick second, but I think regarding to the demand at the moment, people at the end of the day will always need a roof over their head. So whether the economy actually goes up or move down, people will still need a place to stay at. And currently, Willie also did mention it, should there come a recession, a lot of the homeowners and owner-occupiers will actually scale down and move into multifamily sectors because they can just get a lot more lifestyle for their dollars at the moment. Currently, people do not want to live in the white picket fences suburbs anymore, but they prefer to be closer to the CBDs and urban environments where they can live a more trendy life effectively, if you would like. A further reason for optimism with wealth migrate is that we have noticed that the supply has not entirely kept up with a large surge in the multifamily households at the moment, specifically in the markets with Texas and more to maybe to a bit back in North Carolina as well. Just a quick stat there, the number of renters per household increased by 9.3 million in the last 10 years from 2005 to 2015 as per the Census Bureau of the United States. So that's a very big plus point which we really adore in supplementing the fact why we are looking into this sector. Also, another thing to consider is with the favorable capital market conditions at the moment, as I said, the trajectory for the rental demand in the multifamily sector is currently well poised for strong and continued growth. Willie, is there anything else that you maybe want to chat? Maybe we'll switch over to some of the details we did find in some of the retail emerging trends from the PwC report at the moment regarding people buying.
Yeah, no. So what this PwC emerging trends report states, this actually comes out on a yearly basis, and as you can see that the cross-border investors and institutional guys are the guys that's continuing investing for the last year in this market. You'll probably ask, but why is the listed REITs exiting? But the fact of the matter is that the REITs only have a certain time frame for most assets, you know. So what they usually will also try and do is add some value, as I discussed earlier. You know, what we've seen in some of the other investments that we've looked through is that the optimal time is usually a 4-year period, and if you sort of trace back as to the recession, it's basically an 8-year trend going back, which means they probably already cycled to properties during this time frame. So if we continue on to the next slide, which is just showing us some more stats around why this market is performing so well, or that we can sort of just confirm the consistent demand. JB, if you
Yeah, sure. I think another thing to note as well, Capital One is one of the bigger banks in America, and actually they have financed some of our medical properties before, and they've done a survey at the end of 2016, and they have full confidence at the moment that the demand will still currently outweigh the supply in 2017 going onwards. You'll see there's a little comparison there between all the property sectors, the apartment sector and the core commercial, and you'll see that the apartment sector, which forms part of the multifamily, which we are involved in, actually comes out tops at the moment what we are looking for. So yet again, some just confidence boosting elements from other people who are with their ear on the ground, and I think it just plays true to the investment criteria that wealth migrates look in before they enter into any other opportunities. I think that's that from the demand side, and moving swiftly over, we'll just have a brief chat on what the millennials actually have on the impact they have on the apartment market. And one thing that's very clear at the moment is with the growing population, yes, the population is getting older, but the biggest, can I say, concentration of the population is at the moment is the millennials, and they are having the biggest impact in the real estate market. But the big thing to notice at the moment is that a lot of these college students and younger adults are saddled with great college debt, and they are also following greater job opportunities, meaning that they have to be more mobile at the moment, and they cannot really afford to take on any mortgages at the moment. So they will prefer to go somewhere where the cost of living is a little bit less, as in these primary cities like New York and Los Angeles, but they're more looking at states in Texas, specifically Houston, Austin, and Dallas-Fort Worth as well. Another thing that I think is noteworthy at the end of the day, you'll see a stat there that currently the average student debt in America is about $35,000, and people at today's age tend to focus a lot more on their education, taking a lot more time to get that back, as opposed to getting married and reaching the old days when it was the norm for 21 years to start building a family. So this just shows that there's a greater demand for people to be mobile and not fix themselves into a mortgage at the moment, which greatly supports the fundamentals on why we are in the multifamily at the moment. So they are having a huge impact regarding that at the moment. I think if we swift over to the next slide there, you'll see that 43% of the tenants who plan to move over the next 2 years are millennials, also meaning yet again that they're not having the capacity to take on any mortgages at the moment due to the combination of tight finances and the specific lifestyle preferences that they are looking for at the moment. Also, you can have another stat that's saying that around 51% of the renting residents are under 30 years of age, and that's mainly the focus we have at the moment. Also, an interesting stat that Fannie Mae, one of the bigger banks, brought out, saying that 62% of the renters are within the multifamily age group at the moment, and they will struggle to obtain a mortgage even if they had some interest to do so at the moment. So that's a very big fundamental attraction to us regarding to what impact the millennials have on the apartment market. I think moving over, we're going to chat a little bit more on the lower cost of capital and why that's so attractive for us. And I think, Billy, you more qualified to chat regarding this, given that you have about 15 years experience in the investment banking sector. So over to you to chat on this.
Sure.
Billy, just quickly before we get started on the lower cost of capital, sorry, I'd just like to run a poll for everyone, for those of you that are listening attentively. If we could just run a poll of you, and we'd just like to get a better idea of your understanding of the multifamily sector. So I'm just going to run this poll for literally 20 seconds, and then we'll move on to the next topic that we had up there with the lower cost of capital.
Thank you, Ricky. And I think while the attendees are entering that poll, I think maybe just one thing to highlight, which I alluded to in the beginning, is the big fundamental advantage for multifamily is not being, as opposed to a single residential house, being dependent on one tenant, but you actually have an asset being on dependent, in some cases 100 tenants or 200 or 250 tenants. So Billy did touch on that, but I just think that's important to highlight that out. I'm not sure if we did touch on that, but thank you.
Perfect. Thank you so much. We've got about 70% of the people voting so far. If we can get it up just a little bit higher, give it 10 more seconds, and then we can hand over to you, Billy.
Sure.
Great.
Yeah, so when
Thanks
we talk
everyone
about
for voting. I'm going to close up the poll, and Billy, go ahead.
Sure, sorry. So when we talk about a lower cost of capital, it means that when we look at this, usually to really optimize your returns, what we find is that if you can leverage some of the capital, meaning going to a bank and getting some debt on it, it'll effectively, the portion that you've put in, you can actually get more buck for your money. So typically what we're trying to work at is that, and that's one of the things that's so attractive about why we are investing in the US, is that currently we see that you can still get interest rates that's around 3 to 5%. So what is going to happen is that if we look at all the rumors that's been spreading since Trump has been president-elect, and tomorrow he's going to take office, all these initiatives is going to have an influence on what the interest rates are going to possibly do because of the inflation parts of it. So it's always necessary to look where can you invest, where if you leverage some of those some of that capital, how will that sort of increase your return? And that's why when we look at the US versus South Africa, you'll typically find that currently the cap rates in South Africa for a similar type of building is around 8 to 12%, depending on the area, of course, and that's why it's 8 to 12%. Same with the US, it's between 6 to 9%. It all depends on how big the building is, the location of it. It all plays a part. What we do know is that for as you can see from the graph there, the cap rates have been depressing or sort of decreasing, which you want to see. Actually, it's the reverse thing. A lot of people want to see an investment grow, but you want to actually see the cap rates going down. So in some of our other webinars that we've done before, go and have a look as to some of those graphs that we sort of show that capitalization rate going down. So if you then compare it, you want to see that there's a bit of movement allowed when the interest rate starts going up, and that's what's such a great thing about the multifamily, is the fact that there is still a buffer. If the interest rates start moving up, we won't see that'll have a great impact, as if you compare it to South Africa, where your spread is already negative, because you're lucky if you're going to get an interest rate at prime. And I mean, prime rate is already at around 10.5%, and you need to have a big a great history with the bank, a great credit record to even get to prime, and even prime less. So So that's what's making this such a great investment in this sector, is the fact that your capital that you can get is still cheap. Let's move on to more efficient cash distributions. When we look at that, the whole reason behind efficient cash distribution and why we're saying that is the fact that we've got a property that's usually around 200 plus, let's say 250 for instance, which means that there's literally 250 tenants cash flow stream coming into this investment. Whilst when you look at for instance, a single family home or just a normal house or a townhouse, if you have to compare it, if you're the type of investor that likes property, and most of us that's got the means of, has already looked into and probably own one or two properties. So what you know for a fact is the fact that you only have one tenant. If something happens, he loses his job, he's out of there, and you struggle possibly to get a tenant in place. There's a month or two that passes by, which means you don't get cash coming in. Whilst on the other side, with this spread over 252 units, you really need to lose at least more than 20% to really have an impact on your cash distribution. So that's why if you in this sector, and what our strategy around investing in this is finding a property that needs some attention, that you can boost there's still room to boost the rents, which means effectively, whilst some of them moving out, you can upgrade the property, the unit, and then increase the rate with the new guy that you are replacing it. So yeah, making your cash distribution just far more efficient, because you're dealing not just with a couple of tenants, and that's why also it's such a good attractive investment versus your commercial, the other commercial assets, because if you look at some of the medical facilities that we also invest in, I won't say that the risk is, we know that on the medical side, we've got the doctors, so that's where your risk is sort of kept in. But if you compare it now to an office where there's only maybe 10 businesses in, it means if you lose one, it's already 10%, so it's quite quickly where the numbers start adding up when you start losing tenants on even the other commercial assets, even if you don't, if you compare it to just on the commercial sector real estate. All right, let's move on to the next one. All right, enhancing the annual cash-on-cash return. I think I've sort of touched on it, but it's quite important to just to underline it as well as a simple fact is that like the Russian proverb say, don't buy the house, buy the neighborhood, and that's basically what you get when you're looking at a multifamily real estate asset. It is a community. You've got a lot of tenants in there in a great mix. So what you find is apartments have a long track record of having the highest risk-adjusted investment returns compared to the other properties, like I just mentioned. The sector has proven the most resilient during the economic downturns and delivering superior returns during recession periods. So that's just again enhancing the cash flow by ensuring that you can add value to this. If you lose one or two tenants, it means your cash flow is you are in control of the cash flow. Why? Because you can look at various options to improve it. You can if you've managed the facility, like JP also mentioned, and you can get the costs down, it's going to enhance your cash flow. So what we're typically seeing and happening is if we move on to the next slide, as I say this, is partnering up with the right guys. And if we look at one of the partners that we've built a relationship now over the past couple of years, is that they invest in multiple assets. They've got over 4,000 guys units that they manage and facilitating, which means partnering up with these guys ensures that you are able to unlock some additional cash flow to it, and making sure that you have not how will you say it, the time constraint as to finding a tenant. If the tenant has made some dents in your place, you need to do some maintenance, finding the right maintenance guy. What we do is, and what we pride ourselves at is the fact that we are partnering up with guys like the PPA Group. It's got 4,000 units under the contract. They've been in the business for at least over 10 years. They've been nominated for a couple of prizes. Got over 120 people working for them, what they basically do is they go out, they source the property, they make sure that the tenants are looked after. You know, if the tenant has got a need, they make sure that that gets sorted out. Improving the rent roll by doing minor increases. For instance, the one property that we're looking to partner with them is in Houston, where they look to just change the interior on the inside, and that means that they can effectively raise even the rent rolls by 6%, whilst if you look at compare it to other assets, it's around 3%. So these guys basically do a whole turnkey in which they ensure that the building is kept after, your rent roll is increased, and if there's tenants that needs to be moved out, they sort that out. So it's a one-stop shop that these guys provide for us, and we're quite comfortable. We're looking at doing some more partnerships with similar type of partners that's got a track record. You know, we've got a criteria that these guys need to meet. We look after their credit record and if they had any litigation, because we don't want to partner with just anyone, you know. So and that's always important. Yeah, I don't think if you guys want to add some more, I think that's about the 7 points that we want to cover tonight.
No, I think thank you for your Billy. I think you covered it quite substantially, and the key in any business relationship is having confidence with the people you are in business with. So, as you alluded of, included there that the PPA Group has been involved in the market and they've got a remarkable record. So that's definitely a big advantage for us. So, yeah, back over to you, Ricky.
Perfect. Thank you so much. I really appreciate that information, JP and Billy. At the start of this, we asked the question, rate your understanding of multifamily. I hope that after that bit of insight, you've got a better idea into multifamily and as to why exactly it's good. We're going to be specifically looking at right now an opportunity which Wealth Migrate currently has in Houston, Texas, and multifamily opportunity, obviously in line with the topic tonight. The group and the partners that we're dealing with is the PPA Group, which Billy touched on briefly just before the slide. And looking into the investment itself, as I've already alluded to, the location is in Houston, Texas. It's multifamily. There's going to be 252 units in this acquisition, and you can see the square feet is 195,724 square feet. This is the same group that manages PPA Group, which Billy mentioned, that has over 4,000 units. So you can see over here, this is just a small part of a very experienced team's portfolio. The deal value itself is $15.702024, so that's $15,702,024. The project equity and the equity raise amount, which we've been dealing with, is $5.9 million. The duration of the project is a period of 4 years. The internal rate of return there is projected and estimated to be 19.6%. The investment income, the average is 7.9% per annum. And that those distributions will be dealt quarterly. I was just having a look now at some of the questions that were coming through. Shan, thank you for some of those questions. In terms of the dividends, he just wanted to know whether the distributions get paid out at the end of the term or during the life of the project. And just to be clear, all the distributions get paid out during the life of the project, and obviously the final distribution on the sale of the actual acquisition of the building will be your final payout at the end of the term. So the minimum investment at the moment, we've managed to drop this to $1,000. It's really an opportunity of a lifetime to actually be able to invest in a commercial building like this at an entry level of $1,000. And in terms of the internal rate of return, Billy, I don't know, I'd just like to hand over to you here quickly, just to give us an idea of the value add that is actually being done to this building to be able to achieve returns like that, so that we can just look at some of the models that we discussed around the sector now and how PPA is actually implementing these to achieve that kind of return, such as the increase in value creation.
Sure. So how it works is that, like I said earlier, you know, the typical buildings that we're looking at is around the 1980. This specific building is dated from 1980. Currently, 50 of the 200 units have already been renovated on the inside. The property was recently given a new roof and some good painting on the outside, so the exterior was properly upgraded, but the interior was still lacking. So over the next 2 years, we're going to see around 200 units being upgraded. And when we say upgraded, it means that they're putting up some new typical. They've got stoves and microwaves and all compliant appliances, and new painting and what is it called? I think it's carpets, as well as doing the kitchen over. You know, so they're raising modernizing the units, which means effectively it actually allows us to, I think it's around increase the rent roll by over 6% over the next 2 years by just changing this up. Currently, the vacancy is around 90%, and we should see that increasing after we've done the renovations. In saying this, the current cap rate that we are forecasting on is around 6.5%, which is quite conservative. And I'm trying. I don't have my number now close, but we're actually buying it at around, I think, 8% cap rate, if I remember correctly. You know, so you see that there's a bit of a compression. Let me just double check those numbers, otherwise someone's going to quote me. Yes, it's 7.5% that we are purchasing at, and we're looking as the current capitalization rate is around 6%. We've forecasting it should stay around 6.25%, just because of the high demand, as we've alluded. So yeah. So in saying that, it means that we should be seeing some good returns at the end of the period. The other reason why the returns is also a bit higher, if we compare it to our medical properties, is mainly due to the fact that we've got a portion of preferred interest in that in the investment that we're making a provision for, that will basically also allow the guys that's investing in an investment like this to have additional capital gains.
Great, thank you so much, Billy. For those of you still looking at your screen and not flicking around through your browser, I'd just like to highlight that we have got a quick poll out with regards to what is your ideal investment amount. I see a couple of you have already voted through, just a little bit over 60% of you. For those of you that aren't aware, there's currently a poll running. I'd also just like to highlight quickly, while I've got this opportunity, that although the minimum investment starts at $1,000, we've had investors literally investing up to over $1 million in some of our projects. So just to put it out there, that is the starting point. That's not the ending point. And we've got a lot of investors, very, very sophisticated investors, that have actually participated in multiple projects. I'm just going to close this poll off quickly, and then we can move on to the next slide. Okay, so people want to know what I earn in my wallet. Those returns are that we spoke of now are all well and fair, but how does this break down the average investor, and what actually happens in terms of cash flow? So what you'd earn in your wallet if you invested $10,000, we've got over here. So remember, we get quarterly distributions. Every 3 months, payments go out. The amount would be $184 per quarter in year one. So we've got a total there of $739. Total year two would be $863. Remember that we also still get paid out quarterly. We're just not showing every single quarter's distribution. Total year three will be $720. And then the capital gain from the sale, which will end in your pocket, will be $6,389. Vili, just something for people to take notice of over here. We've got quite a bit of fluctuation in the cash flow from year 1, year 2, year 3. Maybe we could comment a bit on why that is the way that it is, just very briefly to give people a good idea.
Yes, no, thanks, Ricky, just in mentioning that, because that's definitely the question will be why you're telling me now you're increasing the rent roll, but in year 3 we're actually going to get less. So the reason being is that in the first 2 years we've got an interest-only loan, which means by year 3 the interest and principal needs to start being paid back, and that's predominantly the reason why the return will drop a tad. That is the main reason there.
Perfect. Thanks, Billy. So I was just hoping to answer the question before anyone needed to ask the question. I think we did that quite well. The total in year 4 you can see is $7,230, and the estimated return in total. So for every $10,000 that you invest, this is what you will get back out. It will be $19,554, and that's over the life of the project over 4 years. If we can just move on to the next slide. Okay, so this is a bit of an overview in terms of the pictures and what we're looking at the project. You can just keep flicking through. You can see the building on the outside. On the outside, you can see the building still fairly new, and it's mainly the inside areas, I think, that are going to be renovated. Please correct me if I'm wrong, Billy.
Yes, that's 100% correct. It's only the insides.
Perfect. Okay, so you can just keep swiping through there, JP. All right, we've got the quick recap. JP, I don't know if you want to take us through that quick. JP, are you there?
Sorry, I was just muted there for a second. Yeah, Ricky, thank you for your time and your input, Billy, as well. And I think just before we head home for the night, I just want to highlight the 7 key considerations regarding multifamily investments that investors need to take note of. And one of the first one that we've delved into that is the creating of capital appreciation is where input literally will result into output, as opposed to you being directly dependent on the sales of the market around you when you are looking at single residential housing. And we've touched also greatly on the consistent demand at the moment, and mainly specifically the impact on what the millennials have on the apartment market. Vili has also delved in quite on depth on why the advantages of a lower cost of capital and why it does actually result in more efficient cash distributions, and also the attractive risk-adjusted returns. And Billy also did mention in quite depth the partners that we are involved with and why it is so important to have a full turnkey partnership involved with this, as opposed to trying to do and take these projects on remotely from anywhere in the world. So I think that's the 7 key highlights for 2017 in multifamily to consider. I hope this is something that is tangible that you can take home and apply to any future investments, considering any multifamily investments. And I thank you for everybody's time. Maybe, Ricky, if you want to just take them through the next steps. If anybody wants to get involved, what do they need to do?
Perfect. Thank you so much, JP. So if anyone wants to get involved, the next steps would really just be to go onto our platform and sign up. So for those of you that don't know, you'll need to go to www.wealthmigrate.com. On there, you'll get a much better idea of the company and the investment itself. You'll be able to see a lot of the details around the investment. Please look out for some of the sections as to where you can actually download the marketing brochures and get a better understanding. We've also got our property supplement on there. As you saw at the start of the actual slide and presentation, you'll be investing in listed equity, and as part of the compliance, we actually put together what's called a property supplement. And you'll be able to download it on there and get a much more comprehensive idea of the full project, the transaction, and how it takes place. So once you've registered online, You can actually do the full transaction online, and you can go ahead and invest and manage your portfolio all through the portal. It's a fairly simple process to follow, and I think daily we're looking to refine it. So any feedback would be welcome. With that, I would also like to invite a quick FAQ section. I see that we have got some questions that have come through already, but right now this is the opportunity for anyone else that would like to ask questions. So please just start typing them into your question bar and comment section. In terms of the first question we've got here from Luck Jacobs is, how sure are you to find a buyer for the scheme in 4 years' time? So, Luck, what I'm going to do is hand over to Billy. He's been dealing with the partners, and one of the things that we didn't talk too much about, and that I'm glad you raised, because it's always most important in any property investment, is really trying to determine what the exit plan is and how they plan on exiting. So, Billy, I'm going to hand over to you here to answer that one.
Sure. Thanks, Ricky. No. So how it works is that in 4 years' time, the idea will be to exit it and place it back in the market. The thing that you need to consider here is that due to the size of this type of investment, once you started raising the rent roll to the optimum rate, it'll mean that there's a good cash flow going in, coming out of this investment. And that's the type of deal that the institutional guys and the REITs like to invest in. They don't invest for a value add per se. They're looking for a constant cash flow, like we mentioned earlier. It's a stable cash flow from the property. The risk is a bit lower than from a tenant side, and that's the type of guys that we're looking out for a greater investment opportunity like this. So we should be seeing some institutional guys picking this up. I think if I got my numbers correct, let me just confirm that quickly. But this market is around 130 billion transactions that has taken place just last year. It has increased till the end of 2015 of around 19%. So we see there's a lot of market activity going on. So we don't foresee that there should be any big problems in getting a buyer for this on the other side.
Perfect. Thank you so much for that, Billy. The next question which has come up here, we've answered it on previous webinars before in the past. The idea of tonight was more to give you a better overview of the multifamily sector rather than going into details on the specific opportunity. So if you'll go look at our YouTube channel on Wealth Migrate, so just search for Wealth Migrate on YouTube, you'll be able to have a look at past webinars. But maybe if you could just briefly touch on why Texas and why Houston specifically.
Okay. Yes. Yes. It's always great to get these questions. So when we talk about the Texas, that's one of the places that, if you consider it's bigger than New England, New York, Pennsylvania, Ohio, Illinois, Puerto Rico, and Cuba combined. It's the second largest population in the U.S. and 80% of these population live within the Texaplex, which is the hotspot innovation for opportunity and growth. They, when we say Texaplex, it's basically you can form a triangle from Dallas-Fort Worth in the north down to San Antonio to the southwest, and fitting Austin and Houston to the east. They forecast around 40 million residents will be moving into Texas by 2030, from around 27 million currently already living in Texas. The reason for this majority change, and that's one of the criteria when we look at investing, is the fact that we want to see population growth. And what you find in Texas is that there's a lot of people migrating from the other states down to Texas because of the no state income tax or tax on goods in transit. So that you'll see that there's around 50 Fortune 500 companies. It's the second most Fortune 1000 companies in the US. The annual income output exceeds over $1 trillion, and it's the largest export of goods in the US, gross more than $260 billion a year in trade. Houston, now a lot of people think Houston is the energy capital of the world. It is true to a certain extent, but because of the volatility in the oil price, Houston has also become one of the states where only a third of its GDP actually comes from the energy market, and they actually have invested a lot in other industries like manufacturing, healthcare, and aerospace. What is also attractive is the fact that, like I said, Houston, what we want to see is the population growth. It's the fourth most populous city in the US, with around 2.2 million households. It grew over 160 people at the end of 2015, and it's the 26th largest economy in the world. So if it was ranked as a country, yeah, so for us that's why it's attractive. It's got the growth, it fits all our criteria, and yeah, and the property is well located. That's one of the main reasons why we like Texas, and we're happy with Houston.
Perfect. Thank you, Veli. The next question we had from Shan Mo was any upcoming investment opportunities. Shan, I believe we covered that in the presentation. That question was probably asked just before that. So I'd really encourage you to go to Wealth Migrate and have a look at the Cypress Ridge opportunity that's in Houston, Texas, and to really just look to invest from there if that's something that you want to participate in. From Luke, we've got what is the basis of these returns, occupancy, cost of renovations, increased rentals. We had Veli cover the strategy a bit earlier that this has been addressed. Where is the scheme registered? So it's not an investment scheme as such. The way that it's currently being set up, as we mentioned at the start, is it is a listed equity, and the equity is being listed in the Seychelles on the TropX. The SPV that actually holds the property is based in the United States. And everything happens according to a distribution agreement, where all the profits that have rights to the all the profits that you as investors have rights to flow back to the listed entity in the Seychelles, and from there you'll receive all of your dividends paid out as a foreign dividend. So all of your distributions get paid out as a foreign dividend, as well as your capital gains. And I would encourage you, if you've got any tax questions related to that, to seek tax advice from a tax advisor. Any upcoming investment opportunities, again, was one of the questions. We've addressed that. And then Rion Miller wants to know if you can buy one of the properties after 4 years. So Rion, just to give you an idea, the whole single family sector is driven under single title ownership. So unfortunately, you won't be able to buy one of the properties. And I believe that's it. I've got no other questions coming in at this point in time. So once again, I'd just like to thank JP and Veli so much for being online and assisting us this evening. And even more importantly than them, I want to thank all of those that attended this evening. We genuinely appreciate your time that you've spent with us. We hope that we've been able to add value to you. And as mentioned below over here, if you are interested in reaching out to us directly as opposed to going on through the platform, please stay in contact with Jason at wealthmigrate.com. Jason's our sales manager, and he'll be able to assist you and just point you in the right direction. Without any further ado, I just want to thank you once again for being here, and I think we can close off this webinar. Thanks, guys.
Yeah, no,
Thank you,
thank
Ricky.
you.
Thank you.
Cheers, everyone. Have a good evening. Goodbye.
Bye-bye.